Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. Ice or sugar in New York. The key recent feature here in recent weeks has been the late April to date descending wedge pattern, currently 2387 to 2506, highlighted in dark blue on my daily chart. This morphed from an original sideways triangle into a descending wedge pattern 4 weeks ago, and then 2 weeks ago the market broke out over the upper trend line. However, the move up soon got caught within congestion from early May and from the March 2012 high at 2620. This halted the rise and pushed prices lower, back within the descending wedge pattern, such that the move higher may even be regarded as a possible false break higher. The move down broke through two key supports. The first was the rising short medium moving average, currently at 2540, which was disappointing as this helped hold up the market 3 weeks prior. However, the second was, I suspect, more eventful, as it had been the core of the recent support, and that was the 38.2% absolute Fibonacci line at 2488. Prices sliced down through these after only hesitating last Thursday. All in all, last week would have been a great weekly reversal down if only the market hadn't made a lower high last week compared to the previous week. Well, that is done now, and Friday's move lower stopped just ahead of the combination of the July 2022 high at 24 even, the congestion at 2390, and the very recent 50% Fibonacci line at 2388. So where does this leave us now? Well, last week we seemed to have a confirmed break above and out of the descending wedge pattern. And this week, well, we're back within it. I'm minded for the moment not to retire the upside targets for the descending wedge pattern. Not yet. Thus we still have for the moment a primary target X in the 27 even area and a secondary target X1 in the 28 even area. However, I may well retire these targets if this carries on lower, especially out through the bottom of the descending wedge pattern. This leaves us with just the big picture items. And here we have an interesting pair of potential pattern ideas. The first idea is one I have previously put out, and that is to look at the action since mid-March as a possible bullish halfway hesitation. We are not yet near to confirming this, but it is still a reasonable idea and not overly affected by the recent drop. So if that were to be the case, then on top of the descending wedge break higher, we could also see a move of possibly full 7 cents. This would be quite extraordinary should it occur, and one to bear in mind. The contrary is that we form a double top on the April high at 2742. Thus the action there and even up to the target area of X1 at 28 even would be very interesting to see and follow should we get up there. However, we'll have to wait and see how all that plays out, if we even get up there. But at the moment, I'm not keen on calling last week and the previous week's action a second top, not yet. Ice Europe white sugar in London. Last week, there were a number of possibilities in this market. We first looked at what we did know. Well, we had an April to May bull channel which broke out on the downside 3 weeks ago, reaching its target roughly in line with the mid-April low and the July 2012 support at 663.70. Most importantly, there was indeed a weekly key reversal down here in London sugar, but not in New York sugar, though that came awfully close, to be honest. We next have a possible late April to mid-May bearish shift pitch hook, or rather we did have last week. I've retired it this week. It's not much of a loss. It was not secure in viewing it that way anyway when I last spoke. I've instead drawn a mid-May downtrend, currently at 707.90, with a view to possibly connecting the lows next time since mid-May and forming a possible bear channel. However, we'll have to wait and see on that one. Then we had some of the big patterns. Now, my first idea was to look at the action since April as a possible 3 peaks and domed house pattern. This pattern is rare, but a large pattern. As a consequence, though I have seen elements of it here, I was not happy about this being a true pattern. And I thought about leaving it there, just at that, at least until I see further evidence. However, I've studied the action more closely this week, and I realize that maybe it's the mirror of this pattern that might be the possibility here. In other words, a domed house and then the three peaks, not the three peaks first. I'm just going to leave that out there for now and see how this idea works or doesn't. The second pattern I looked at, and one I suspected had a greater chance and opportunity, was the idea of the action being a rounded top. This is still out there, but I personally seem to have less confidence in this idea this week compared to last week. One piece of action I can say has actually happened is the late May to late June small bearish halfway hesitation, almost a bear flag pattern. This has already reached its target below in the 660 area and seemingly started to hesitate there. Today this hesitation is interesting as it's on the cusp of another pattern, something I laid out last week. To look at the whole mid-March to date action as a possible double top, Eve and Adam type. We'll have to wait and see if the market chooses to continue the move lower or revert back up. But the July 2012 high at 663.70 is becoming a key level for such a pattern development. Sugar white premium spread. We are far into 2023 and this chart is still one of the busiest charts I have and also one of the most colourful. Many things are going on all at the same time. Okay, so I'd previously spoken about two big picture items seen here on this weekly chart. We have the recurring big old bullish Andrews pitchfork from 2019 to 2021, highlighted in dark blue on my weekly chart, with the market at the moment in between the lower time below, currently at 103 even, and the middle time above, currently 177.25. I've said this so many times before and I will repeat it here again. This pitchfork, despite being breached in the past, still continues to show the overall major bullish angle attack of this market. Next we have an ascending expanding wedge pattern highlighted in bright red trend lines and above the current market. This was formed between mid-April to late November last year and it's currently 187 even to right off the top of my weekly chart. To me it was and still is not the best looking of such wedge patterns, but it is also still out there, despite being tested as recently as mid-April this year. And it comes with all the possibilities such a pattern invokes. The most recent activity had been the market's move up through the slowly rising long moving average, currently 130.75, followed by a move back down and all the way through the slowly rising medium moving average, currently 126.5, followed by a resurgence back up, such that we seem to be spending a lot of time, especially closes, either on or near the moving averages or in between them. We have seen this action push down through the two 50% Fibonacci lines at 128.75 and 131.5 and the June 2020 high at 134, much as if they weren't even there, though the 50% Fibonacci lines are doing a reasonable job so far of capping the market. 2 weeks ago I drew a bullish Andrews and a bullish Schiff pitchfork for the August 2021 to February 2023 action. And I have once again not highlighted either of them, as they neither add nor subtract from the current picture. I'm still open to drawing a bearish pitchfork of some form to muddy the waters even further for the mid-September to mid-April 2023 action, but I'll see how prices treat the bullish pitchforks first. Now, the final point, and it is a big picture item I had mentioned 2 weeks ago. It is to look at the whole 2022 to date action as a possible huge lopsided diamond pattern. Now 2 weeks ago I just lodged that idea in my own and in your mind, as there are elements of such a pattern here, but there seemed to be enough going on elsewhere that I didn't wish to unnecessarily burden you with the mess of lines we already had. However, last week I decided to go ahead and draw this potential diamond top here, which you can see in dark green. And as you can see, prices have broken out of the bottom of this pattern, though it has not really been confirmed as yet. However, I can give you an idea for the potentials for such a break lower, should these become confirmed in the next week or so, and also if we don't have a false break. Thus, a primary move would be about $94.25 off the confirmed break lower, with a harder secondary move of about $149.50 off from the confirmed break lower. Let's just say for the moment the secondary one is not an option, as it will be below zero, which is hugely unlikely possibility at the moment. Even the primary one would be a huge move. So I'll just leave it at that for the moment. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.